Good afternoon, ladies and gentlemen, and welcome back to Finom Group's weekly State of the Market. I'm your host, Seth Golden. I'm kind of switch things up a little bit here this week. Every week when we do the State of the Market, we look at a number of different variables impacting the market, everything from the economy to politics. And then, of course, we get right into the market, looking at breadth, looking at market internals, looking at the trends, looking at different charts, seasonality, a lot of quantitative data, and the like. This week, I really want to talk about investing. I want to talk about investing. I want to talk about trading. I want to talk to you basically as the active portfolio manager. I know this isn't one-on-one, but this is as much of a one-on-one as we can, possibly deliver. So with that, let's check things out. We're talking about the long game here. That is, the nature of investing. It's thinking long term. Any investment capital that you're managing should be capital that you're looking to appreciate over a number of years, if not decades. That doesn't discount, obviously, the ability for any given investor to actively trade the market's, intra-year swings, intra-quarter, intra-day swings, so on and so forth. But within that context, what we talk about a lot here at Finom Group is acting on local price, but with a long-term, goal in mind. So as investors, we're always thinking long-term. As traders, we're actively engaged in local price activity. Investing takes time. Well, duh, right? Now, some of you have seen this quote before. I kind of wanted to refresh it because it's still so darn true. And in this social media frenzy, if you will, of a world, we can kind of lose sight of all of these investing disciplines because there's so much more noise out there. And quite frankly, all that noise is in our face and it's in our hands, with our mobile devices. It's literally a touch screen away. All this social media noise really can impact and impair your performance as an investor. So here's the quote. When Jeff Bezos asked the second richest man in the world, your investment thesis is so simple. You're the second richest guy in the world. Obviously, Jeff's the first. It's so simple. Why doesn't everyone just copy you? He was speaking to Warren Buffett. And Warren Buffett answered with, because nobody wants to get rich slow. Warren Buffett is known for doing, hours upon hours of due diligence. Him and his team, obviously not him at this stage of his career, but his team, his analysts, his portfolio managers, and what have you at Berkshire Hathaway. But that's the reality. And it's no more in our face than with all this social media noise nowadays. Twitter is just a breeding ground of poor disciplines, misinformation when it comes to investing and what's working, what's not working, what you should do, what you shouldn't do. Here's what I'm doing. Here's what's working. By the way, I'm lying, and there's no way you can figure it out because everything is anonymous, basically. We got a lot of keyboard commandos that just, litter the Twitter sphere, if you will, of investing, information. But that's the reality. Warren Buffett's answer is the reality. Nobody really wants to get rich slow. We all want it, as quickly as possible, and really quickly as possible doesn't work. Investing takes time. You have to learn. You have to crawl before you walk, if you will. You have to go through hard times. You're not going to become an investor and just immediately have, unbound success without any pitfalls. without any lessons learned. It's not the way it works. Oh yeah, Seth, but I just started a year ago and I'm up XYZ. Come back in 2 years, come back in 3, 5 years. Tell me how that worked out for you. Beginner's luck is great, but when things get tougher as we transition from one cycle to the next cycle to the next cycle in this cyclical and secular bull market, the market likes to weed out those who are lucky from those who are disciplined and actually skilled. Take your time. Investing is about time. Don't try to get rich quick. So that's Warren Buffett and Jeff Bezos. Like, if you couldn't pick any two greater mentors, but if you had to, man alive, Howard Marks. He did a fantastic interview recently, and the link is here, so you can check out the interview at your leisure. But in the interviewer asked Howard Marks, he's the founder of Oak Tree Capital, if you're not familiar. His investment year spans 50 years. He's written, dozens upon hundreds of newsletters, probably thousands of newsletters. He really ramped up his writings during the pandemic period because he saw the blood in the streets. He saw the opportunity. He saw not just the opportunity for investors, but the opportunity to deliver education and real sound information. His newsletters that tend to come out quarterly back then were coming out on a monthly basis. So he was giving you an opportunity to block out the noise and hone in on just hard, experienced facts. But in this interview, he was asked the question, one of the things that you've written a lot about is the role of psychology. You already mentioned it in the sort of third stage, if you will, of the bull market. When at market extremes, do you think that psychology is even more interesting for investors to consider than the quantitative data about companies, markets, or PE ratios, or what have you? Here's Howard's answer. I think so, because the quantitative data is what's right and proper in the long run. In other words, you're helping the market to act as a weighing machine, as Ben Graham said, an intelligent investor. But in the short term, it's a voting machine to get a handle on how people are voting and how they're likely to vote in the future and whether that'll change. I think you have to study psychology, which is, let's say, what determines who wins the voting, who wins the popularity contest. So I think that studying psychology gives you a great advantage. And I think it's incumbent upon the investor to understand it. If you want to understand your market, you have to understand the motivation of the people in it, because that's all the market is. I would say that my market calls, if you read the memos in which I talked about how I felt about the market at various junctures, there's not a lot of numbers in there. I don't say that the PE ratio is too high or too low, and the earnings estimates are too high or too low. What I say usually is psychology is too buoyant or it's too negative. And if you look at over time at these memos, like the race to the bottom in February 07, which said that the market was being too positive, or let's say it's all good from July 1st of 07. They were all talking about the fact that people are thinking too positive. And then I wrote a memo called The Limits to Negativism in October 08, which was the low point of the cycle. And it was talking about the fact that people are being too negative. So to me, it's a great indicator, but it's not sufficient. Psychology is not sufficient. It's necessary, but it's not sufficient. And at the present time, everybody's wrestling with the question whether we're in a bubble or not. There are a lot of the traditional indicators of bubbles out there. I've had trouble concluding that stocks have a lot of vulnerability because I see very good economic data and very good economic news for the next, let's say, 9 months. And if I find it hard to see the market collapse while very good economic news is being announced. So I'm not relying just on psychology, but I think it's important to understand when the market is experiencing psychological excesses, like in 2007. Psychological excesses in 2020 when we marked the bottom. So, psychology by itself, Howard Marks is saying it's not enough, but you should understand it. You can pair that study, that education with the quantitative data. Because at the beginning of this response, he says the quantitative data is what's right and proper in the long run. That's why we do what we do here at Finom Group. So how can we use Howard Marks's commentary about psychology, but also, pairing it with the quantitative data? What's like the biggest or one of the bigger hot button topic items today in the financial media world and amongst investors is, when is the first rate hike? Right? Everybody looks to that as being like this big cataclysmic negative event. The reality is we have the data, going back to 1987, we have the data that says, sure, in the first 3 months, the markets basically go nowhere after the first rate hike. But the next 6 months, the market's up a good 7%. Remember, usually when we're hiking rates, it's because the economy can withstand that. It's because the economy's doing well. 12 months later, after the first rate hike, we're up double digits historically on average. The only time we really weren't was 1987. We know what happened there. We know what happened there. And it took some time to recover from that. Kind of an exogenous event, Black Monday, October of 1987. So although the first rate hike likely isn't for another 2 years, we've seen the Fed's dot plot recently. We got another meeting coming in late July, like the very end of July, and then they got Jackson Hole. But there's no rate hikes this year. We've seen some of that dot plot that was forecasted for the first rate hike in late 2023 kind of move up to early 2023, if not the very end of 2022. We're still a ways off from that, and so much can change between now and then. So do keep that in mind. Again, disciplined investors, you need time. And here's a tweet from the Longview. It's a very popular account on Twitter. Like I said, there's a lot of noise out there on Twitter, but there's also some good information. It's up to you to weed out the good from the bad. The problem with Twitter is it kind of tracks where you go. So the more that you go to these type of accounts and places, keywords on Twitter, it will populate in your Twitter feed. Again, that's just par for the course. You have to know that aspect of SEO, search engine optimization within Twitter. But this particular, most important trading rules for me: don't fight the trend, and don't fight the Fed. Start with valuations, but don't think it matters in the short term. ST is short term. Cut losses quickly. You've heard that, take small losses as opposed to, letting those small losses develop into big losses, which, I'll get to my size small enough you never cry. That's something we preach. That's one of my hallmark strategies. I generally don't take, for scalp and swing trades, I generally don't take more than a 1% weighted position in the Golden Capital portfolio. If I take a 1% position, all of a sudden the trade goes against me 10%. Doesn't really matter. I can withstand that. It's a blip. But if I took a 5% weighting and it goes against me 10%, I got a problem. It's going to weigh on your psychology. take small positions so they don't make you cry. They don't change your psychology. Stay factor aware. What does that mean? Well, what's working in the market? What styles, what factors are working in the market, and why? It's not enough to know what's working, but why is it working? Know the general narrative and when it reaches saturation, right? The general narrative that we're going through presently is the reopening cycle, the reflation cycle. What's the factor or style that's working? It's the reopening. It's the cyclicals that by and large has been the style or the factor awareness for investors. Last but not least, he says, stay flexible. Absolutely. Look, the market is not predictable in real time. You always need to approach it with a flexible, unbiased manner. Now, I agree with most of the trading rules denoted above. Shy of cut losses quickly. This is something that people say. It's easy to say these things. It's easy to, put these out on Twitter and, people, oh, well, I believed it. Now, keep in mind, this individual, although it's not verified, says that he was a Bridgewater Capital associate. He worked for Bridgewater with Ray Dalio's fund. So people take it as if it's the gospel. But again, cut losses quickly. Now, here's the problem I have with that. This rule is more colloquial than practical when you're thinking about, look, I want to outperform. I don't want the average S&P 500 return, which is essentially a little more than 8% if we go all the way back to 1926. So from 1926 to present, the average annual return is a little more than 8%. I can do better than that, right? We all think we can do better than that. We should strive to do better than that, but it's hard. It's hard. If you cut losses quickly, you're never going to build that ice water in your veins. You're never really going to build that intestinal fortitude for when things go in your favor. As I always say, if you're not able or willing to take a double-digit drawdown, why would it be logical that you're patient enough to take a double-digit return absent some kind of lucky headline, right? We push that luck to the side. We just, for the medium, we think about skill. If you're not willing to take a double-digit drawdown, don't fool yourself into thinking that you have the patience to take a double-digit profit and wait for it to get to that level. So again, that's why I say this is more colloquial than practical. And if you're thinking about outperformance, what do you need? You need a double-digit return. 8% S&P 500 average return, 8% since 1926. Now, I mentioned this gentleman says he had worked at Bridgewater Capital in the past, the Ray Dalio Fund. Ray Dalio has, over a 28-year period, Ray Dalio and the fund has had 11.5% annual return. Whether it was, I think it's pure alpha or the all-weather, combined it's an 11.5% annual return. That is outperforming. Over a 28-year period, you got to give the guy a lot of credit because most funds do not do this. Most don't. Having said that, if you are an investor in this fund, you didn't generate 11.5% returns. That was just the net return. You have fees. The average investor only captured about 7% of that 11.5% return. After fees and management this and research that, it comes down to about 7%. Having said that, it's still a good return, compared to what you can get in your savings account. I think the worst thing about the Bridgewater Associates Capital narrative over the last 30 years is that 11.5% that's great. Like, that's notoriety, 11.5%. I think people can do a lot better than that if they just have the discipline, the stick-to-itiveness, the understanding of market structure and how markets perform over time. This is the Golden Capital portfolio. One of the things that I preach is time, duration. That is one of your best friends. Your second best friend as an investor are when stocks go on sale. Your BFF, your ultimate BFF, your ride or die partner is time. Give yourself time. It's another Warren Buffett, just absolute necessity when it comes to investing. Investing takes time. Give yourself time. I was underperforming for the Golden Capital portfolio. I'm the chief market strategist and chief investment officer. I was underperforming for the entirety of the first quarter. I had a couple nasty dips in here as well, while the market was making new all-time highs. You could make the argument I was in the wrong sector. I had the wrong factors in the portfolio. I didn't see it that way, though. I had a plan. That's the other thing. You've got to have a plan as an investor. You have to have a plan. You have to have entries. You have to have, first and foremost, goals for the year. You have to have a macro market thesis, all of that, and then you start developing your execution plan. What are you buying? When are you selling? Your entries, your exits, your rebalancing, so on and so forth. Your plan should be updated monthly, if not quarterly. I was underperforming for all of the first quarter. I was going after growth. I was buying the dips in tech names. When everybody was selling, I was buying those areas of the market. Our trade alerts to Finom Group members were in those areas of the market. In March, when the NASDAQ, when growth, when tech sold off 12%, I was buying that dip. I was buying what nobody wanted at the time. As an active portfolio manager, you can outperform with swing and scalp trades and building your core holding around that activity. TQQQ, the triple leveraged NASDAQ 100 ETF. Buy 1,000 shares. I get a 1% or greater scalp. I kick out 900 shares. Falls back down, I buy it again. 1,000 shares, sell 900 when it gets me my profit, keep 100. Do it over and over and over and over throughout the year. Now, for a passive portfolio, you're down. You're probably holding on to that one position and doing nothing with it. That's why I'm speaking to the active portfolio manager. You can be in the underperforming factors, the underperforming styles, sectors of the market, but still market to outperform in those areas of the market. When things started to trough here and then trend higher, it's getting closer, to the S&P 500. That's my benchmark for the Golden Capital portfolio. I benchmark against the S&P 500. Started to catch up with it. By pretty much April, I was ahead of the S&P 500 on a year-to-date basis, even if ever so slightly, through all of these swing and scalp trades that we did. Here's TQQQ. We've done this now 48 times. 1%ers, a little more than 1%. Sometimes you get lucky on an overnight hold. You get a little bit more. 48 times to build up to the weighting that I wanted in the Golden Capital portfolio. Apple, Same thing, fewer times, but 18 trades and we collected the dividend to build a core holding. Cost average in Apple is around 110, 111. Stocks trading in the 130s. TQQQ got the cost average down to $52. So 48 trades, and we're still trading it. So the active portfolio manager can be in the wrong factors, aware of what's working and what's not, but more importantly, why. Like eventually it's coming back to growth. Eventually the market will rotate back to growth as we progress through the different cycles. Through all of Q1, Golden Capital Portfolio was underperforming the market, but our active management and willingness to stick to our game plan and disciplines, knowing time was on our side, has resulted in outperformance year to date. It's not just by a couple percent either, folks. Market's at all-time highs. What do we hear constantly? I'm going to wait for a pullback. I'll wait for a pullback. The market's got to pull back. Every time the market has pulled back, it's rallied just like that. You really haven't had the chance. And it seems like every time the market does go on sale, people are just waiting because they think it'll go on a bigger sale. They're waiting for a 5% or a 10% correction. Everybody on CNBC keeps calling for that. It's not just social media, it's the financial media networks as well, television networks as well. And I'm not saying, pullbacks 5 and 10% shouldn't be part of your expectation. It absolutely should be part of your expectation. What I'm saying is have a game plan for that, whereby you're acting on the dips, you're acting on local price so that you can compound the gains. Apple has dipped, twice now from the 130s down into the low 120s or 1-teens before rallying back up to the 130s. If you bought both of those dips and it's essentially gone nowhere, back into the 130s now, you've compounded gains over the 1-teens and 120s twice now here this year. That's how compounding gains work. Everyone says they're waiting for a bigger pullback. They don't want to buy at the highs, despite what the data says. The data says if you buy at the highs, that's appropriate. The returns are no lesser if you buy at the highs than when you wait for a pullback. In fact, a few years back, Sam Lee looked at a simple methodology to demonstrate what a terrible idea it is to wait for a market crash or wait for a pullback. A simple version of the strategy is to wait for a 10% pullback, peak to trough loss before buying. So you're waiting on a 10% peak to trough loss before buying. Then holding what you bought for at least 12 months or until the drawdown threshold is exceeded before returning to cash. For each percentage point of volatility by the dip, yielded only a 0.14% in additional annualized return, and buy and hold yielded 0.34%. So if all you did was just buy and hold, instead of waiting for a dip, you would have actually outperformed. Having said that, you do want to compound, increase your exposure as long as you have that disciplined approach whereby you're taking profits at, predetermined levels. And when that stock comes back down, you can recapture it. Buy and hold is not the only way to invest, but waiting for the market to crash is no way to invest. The cash on the sidelines, which is waiting for the market to crash, is not making you any money. It's exhausting. You won't actually buy the dip anyways. The psychology of waiting to buy the crash, waiting for a bigger correction, does not work because you'll always be in waiting mode. Just execute. Market dips 2%, 3%. buy stocks on sale. Goes down 5, buy more. Goes down 10, buy more. Market is eventually going to return to the upside. Yeah, but I don't want to wait 6 months. Then don't invest. What did we start by saying? Give it time. You have to as an investor. It's a necessary variable to your success. As time horizons grow, equity losses go down. Again, this speaks to, yeah, you may have to take a double-digit drawdown every now and then. So you just extend your time horizon and allow for that stock or for that ETF, assuming nothing has changed fundamentally. The only thing that has changed is price. Allow that stock some more time to come back. We've got that situation right now with our Baba trade, our Alibaba trade. Our cost average is $219. It's gone as low as $203 over a 3-month period, because that was our designated timeline for this trade. It's been as high as $240 where we did take some profit, but we repurchased it at a lower price. So our cost average is $219. Well, after earnings, the stock went down to $203. Our plan for this trade, remember, you always don't go into a trade, don't go into an investment without a plan. Our plan, it's either 250 or it's 200. Gets to 250, we're out. Gets to 200, we're out. With basically a $219 cost average, that's what we're willing to risk on the downside, and that's where our profit potential for the trade is on the upside. It didn't get to 200, got to 203, and since then, it's back up to 219, our dollar cost average. So we're giving it more time. It's been 3 months. We're giving it more time. That's the bottom line. But ultimately, we'll stick to the discipline. If it does get to 200, we're out. We'll take our loss. One of the very few that we ever need to take at Finom Group, by the way. Speaking of time frames and the people that say this market's just going up and we've rallied so much off the lows. This was a chart that we actually looked at a while back. This was the low in 2020. And most people, that's all they talk about. The S&P 500 index notched a 76% gain off the March low. A huge 12-month performance. It's actually this chart right here. Right? That's a 12-month performance. But you're not getting the full context. That's 12 months off the low as of March 2021. Consider 13 months. You just add one more month to this equation, and over that period, the S&P 500 is up only 17%. What a difference 1 month makes. If we include this 1 month here, the S&P 500 is actually, as of March 2021, was only up 17%. That's what the, timelines, perspectives. It's all about perspective, investing, analyzing with your eyes wide open as opposed to your eyes wide shut. Talking about fear of missing out. As I was, mentioning earlier, the whole social media and the meme craze, like the meme stocks and these short squeezes, Reddit, Wall Street bets, like you see all these people that supposedly are making all this quick, fast money. And here you are as the disciplined investor, and you're like, it gets the best of most people, right? You want to dive into that because it does, seem like it's inevitable. It does keep happening here in 2021, these short squeezes and these meme stocks ripping to the upside. So people get this natural, fear of missing out or FOMO. And the question you need to ask yourself, is what kind of investor am I? How have I acted in the past? Because that's probably the best indicator of how well you'll act in the future. Did you sell? Were you one of the many, by the way, the many that sold in March because you couldn't handle the COVID crash? Did you let politics impact your portfolio last November during the election? If you answered yes to one or both, how are you going to handle the unprecedented volatility of high beta growth or crypto assets even? If stock market sell-offs and political views can make you course correct, are you really geared to invest in growth, in crypto, in these meme stocks? I mean, if you've been investing in growth stocks, which have caused many investors in well-diversified plans to chase them due to FOMO, are potentially underperforming right now, and because the market is expecting economic growth to soar in the future. That style just isn't working right here and now, but it will come back. What if your portfolio goes nowhere, investing in these styles, and you're watching the economy boom? Because that could happen if you're in the wrong names. You're in the wrong stocks. The economy's booming. The S&P 500 and NASDAQ are at all-time highs. Like, how are you going to feel in that environment? Here's the big picture takeaway. If you've meticulously funded your big picture with a well-diversified plan, basically committed to eating your peas and carrots, it's okay to dive into some of that meme stuff. It's okay to dive into a bowl of ice cream sundae, every now and then, but do it responsibly. I mean, if that fear, if that FOMO is getting to you, okay, go buy AMC. Make it a really small position. Eat that ice cream sundae. Just get that monkey off your back. Plan the trade. If it works out, great. Then that trading plan worked. And if you want to repeat it, repeat it. Like, we're humans, right? The absolute best investors largely ignore FOMO. In a perfect world, no one would care what their friends are invested in or how that person on TikTok did in GameStop. Warren Buffett, he once said, it's insane to risk what you have for something you don't need. He's right. Make smart decisions with your money, not ones driven by emotion. You got to take the emotion out of it. Best way to take the emotion out of it, as I've long since said, is have a plan, focus on the data, drown out the noise, push that aside, and just focus on your goals. All right, so here we are. Mid-year outlook. Everybody's got their mid-year outlook, including myself. We did have a little bit of that June swoon there that we found last week. We typically do find some selling pressure in June, but that gives way at the end of the month with a nice rally into July. Ned Davis Research, their cycle composite index, suggests a June swoon that gives way to a summer surge. Really haven't gotten us, any kind of a material downside in June. Really was just some time consolidation last week. And now we made new highs here this week. But we're, typically what the composite cycle offers is, a surge into the summer. One of the things that I've said recently is you can perform all the technical, fundamental, and quantitative analysis in the world. If you don't have an execution plan, you're just spinning your wheels. Work on your game plan. Markets change very little over extended periods of time. In a sense, that's why we look at the quantitative data. It tells us about human psychology, human interaction with the market. Markets change very little over time because our human behavior changes very little over time. And speaking of those big gains, right? Since 1928, the S&P 500 has risen 50% or more over a 12-month, over a prior 12-month period, just 1.5% of the time. We've only had those big 50% or greater gains over a 12-month period 1.5% of all years going back to 1928. Outside of if we eliminate the Great Depression, it's only been 0.4% of the time. From April 2020 to April 2021, the S&P 500 index rose 61%. The average gain post such rallies has been just 2% over the next 12 months. Having said that, I know that doesn't sound like that doesn't give us much cause for hope, but we've got a lot of other data suggesting that there's going to be a lot more gains, at least through the end of the year. Nonetheless, the average gain post these 50% or greater rallies over the next 12 months is just 2% when we use these 4 dates here. But that was never the top. It was never the top of the market. Here we are on a kind of a roadmap of the S&P 500. It happened in as the World War II was changing in our favor, and we had stimulus. We had a big gain there, and the market kept going. Here, when Volcker came in and basically was putting his boot on inflation, big gains followed. This was the tech bubble, obviously. Then we had the great financial crisis. Big gain coming out of that. Corrections along the way, those are inevitable, but it wasn't the top. The average return over a 3-year period after these big 12-month gains was 43%, versus if you took any other period, the average return is just 23%. This basically speaks to the fact that we're actually early in a new cyclical bull market. Past performance is obviously not indicative of future results, but you want to lean into the data, as I always say. And again, speaking to all of the cries for a 5 and 10% correction that hasn't come to pass, the S&P 500, as of today, it's 164 days. When I gathered the data, it was 163 days. The S&P 500 has gone 163 days without a 5% correction on a closing basis. Previously, or the most recent longest streak was 2016 to 2018 at 314 days. Before that, 174 straight days in 2015. 219 days in 2003 into 2004. And these are the longest streaks without a 5% correction in history. So when people say we're due for a correction, 5% pullback, there's show me where the schedule is. Somebody show me where the darn schedule is so I can log this in and get out of my stocks, on that day. The market doesn't have a schedule, obviously. There's no due date. We can go for extended periods of time if the conditions are right without a 5% correction, as we have done throughout history. All right, we're going to be in July here pretty soon, folks. July tends to deliver, some decent returns. The last 10 years, it's one of the best months. The last 10 years. Post an election year, which is this year, not as good. Since 1950, which includes a lot of election years, again, decent returns, but less than 1%. As we look at breadth a lot of times, to get a gauge of the strength or weakness of a market trend, recently, percentage of stocks trading above the S&P 500, within the S&P 500 trading above their 50-day moving average last week dropped to 33. It since has risen to 44. When I look at a chart like this, what I say is there's no irrational exuberance in the market, right? I mean, the average stock is actually below its 50-day moving average. How is that irrational exuberance? The other thing is that, or another very important point regarding both this breadth chart up here and the chart of annual percentage returns below. Right? This goes all the way back to 1928, pyramid chart of returns. 73% of market breadth weakness during a secular uptrend is nothing more than normal and to be expected. Why do I say that? Where do I get the number 73% from? Seems like an odd number. Again, we're speaking to market breadth. We study market breadth because, again, we want to know if the uptrend is strong or if it's weak. We can't do a lot when breadth is strong. There's not a lot because we don't know where the tipping point is when all of a sudden it's too strong, and there's just that natural human tendency to start, taking profits. So we can't do a lot with trending strong market breadth. We can do more when breadth washes out. That's more practical. It's more actionable. So again, 73% of market breadth weakness during a secular uptrend is nothing more than normal and to be expected. We spend a good deal of time on breadth market internals, but the reality is that the market is higher 73% of all years. That's where I get the 73% number. Again, going back to 1928, in this box here, you can see, if I can blow this up a little bit, let's see. 68 years were positive, including 2020. Big return, which accounts for 73% of years. Only 27% of years is the market down. Again, you want to lean into the data. So we spend a lot of time on market breadth and we worry about, oh no, it's weakening. And, that means market's going to pull back. We don't know how much it's going to pull back, but that's generally all it's going to do. It's not going to crash. What it's going to do is give you an opportunity. Don't worry about market breadth weakness. Don't worry about it. It's your friend. It may be signaling that if you have a little more cash on the sidelines, you'll be able to put it to work in the not too distant future. Looking at risk on markets versus risk off. I know we're kind of jumping around a bit here today, but I did want to cover a bunch of topics to the best I can. One of the ways I look at risk on, risk off is through the defensive sectors. Like if the defensive sectors are outperforming, probably not a good thing, right? Investors are defensive. They're not really risk on. They're not in the cyclicals. They're not going after growth. So the fact that we had consumer staples and utilities basically at their new lows relative to the S&P 500 tells us, indeed, it's been risk on. They are in the cyclicals. They are in tech or growth, healthcare. Now, these are really low right now, obviously, and then more than likely we're going to get a bounce here, but that's normal and to be expected also. What we're really looking at here is, despite the weakening breadth that we've seen over the last couple of weeks now, it's still risk on. Investors are buying the dips. We see it in the price action. We see it in the factor style performances. Chart crime. Who wants to do a chart crime with me? Like I said, we're going to jump around a bit here, but this is social media again. I grabbed this from somebody's Twitter feed who got tons of likes on this chart. The tweet was from Mac10 Suburban Drone. And he says, the last time we saw these massive divergences was October 2018. And then the market unexpectedly imploded. Now, based on his verbiage in this chart here, which goes back to 2018, you can see the arrows. This is the NASDAQ, the percent of NASDAQ 100 above their 50-day moving average. So now we're looking at stocks above their 50-day moving average in the NASDAQ 100. And you can see in 2018, it was on a downtrend. Fewer and fewer stocks were trading above their 50-day moving average. Okay, and certainly we did have that nasty fourth quarter plunge in 2018, predicated on continued rate hikes, and the Fed was going to be tapering its balance sheet, unloading its balance sheet. Those are two heavy factors. That's tightening, to a pretty, significant degree. The Fed had already raised rates 3 times that year going into the fourth quarter and raised it a 4th time in December. Now he draws the same arrow here. Now, here's my problem with this. We are actually uptrending. This was the more recent low. Only a couple months ago, the percentage of NASDAQ 100 stocks trading above their 50-day moving average was like in the teens. We've actually been in an uptrend. We're at almost the highest levels that we've seen since February of this year. This isn't an uptrend. His vantage point, he's just looking at that particular high. Why not look at this recent low? Why not look at this recent low? That's where we get into the whole intentions. Like, what's this person's real intentions here? To me, this is a chart crime. The bottom panel, I don't have a problem with. Absolutely. New highs, NASDAQ 100 have been shrinking, just like they were in 2018. But remember, what we got here is a sample size of 1. He's comparing today versus one date. When you have a sample size of 1, you don't have a sample. You have a bias. You have somebody who's trying to, again, you have to ask about the person's intentions. I have a problem with him failing to recognize this, but in no way, shape, or form am I critiquing this down here. This is valid, but one breath metric does not produce a signal. So there's that also. And again, I gave you reasons for this. These breath levels are good. This is 62. This is 62. That is good breath, folks. What did we just say about the S&P 500? It got down to 33% of S&P 500 stocks trading above their 50-day moving average. We were at 62 when he's circling these levels. That's double where the S&P 500 was on Friday. This begs of recognizing the difference between causation and coincidence. And there's no better chart. There's no better example than this right here. Ice cream sales and shark attacks. Man alive, do they track each other perfectly. But what does ice cream sales have to do with shark attacks, right? Both ice cream sales and shark attacks increase when the weather is hot and sunny, but they are not caused by each other. Like ice cream, shark attacks don't cause people to go buy ice cream. And buying ice cream does not cause shark attacks. It just so happens that they coincidentally occur when you have more people at the beach or when it's hot out, people eat more ice cream. But one is not causing the other. And that's the situation here. Breath did not cause this here. It was additional Fed rate hikes and tightening policy. There's a difference between causation and coincidence. The NASDAQ, as of this week, has made a new all-time high, and as of today, it's made even more new all-time highs. We have 16 new all-time highs on the NASDAQ this year. We have 30 new all-time highs in the S&P 500 this year. Speaking of the NASDAQ, and are we going to get the rotate? We have gotten the rotation into growth, into tech, etc. Tom McClellan of the McClellan Oscillator, he came on CNBC just yesterday, and McClellan says big tech will lead the summer surge. I like that. I'm in tech. I'm in growth. I'll stay in tech. I will be staying in growth. I will be continuing to trade to achieve my goals on the year. Now, just because he agrees with me doesn't mean I agree with him, and it doesn't mean I take his opinion as the gospel. We heard him say this. Tom McClellan of McClellan Market Report joins the closing bell to discuss why he says the markets could see a dip ahead and how. That was in March. That was the very end of March. A scary feeling market dip is coming is basically what he said on the air back then. What happened in April? The market did nothing but go higher, right? So that's why I say everybody's giving you their opinions. They're trying to put their best foot forward. They do this analysis. They perform this study. They're looking at this research and that. 50-50 on these, he's 50-50. Well, he could be, I should say. We don't know the outcome here. We know he was wrong here. My point is, just because he agrees with my participation, with my sentiment, and where my position is pointed, doesn't mean I trust his outlook. He's given me his best opinion. All of these folks that come on CNBC, that's what they're doing. They're not the Bible. They're not the gospel. They're not giving you their truth. They're giving you their opinion. What we do know is that there is a lot of data that does support this sentiment. Again, Tom's looking at studies. In NASDAQ, there's a 12-day mid-year rally. Historically, if we go all the way back to 1985, there tends to be this 12-day rally. Check it out. I can go over it with you, but the average return over that 12-day period is 2.6%. The 12-day run has been up 28 of the past 36 years with an average gain of 2.6%. But did that get pulled forward? Because the NASDAQ has been continuing to rally. It starts, this 12-day period, starts the 3 trading days in anticipated over the last 3 trading days of June and the first 9 trading days of July. But again, this is more seasonality than anything else. So what did we find out in June? Well, we haven't gotten a June swoon. It's always best to pair seasonality data with other studies. Just saying. The NASDAQ has achieved new all-time highs this week, but the index also has a chance to finish the halfway mark higher, like the halfway point of the year higher by 10% or more. We came into today up 10.73% on the year. Good things. Forward 1-month returns at the halfway point. If the NASDAQ is higher, good things continue to happen. The average returns are positive going out over the next 12 months. What I look at, as always, is the positivity rate, 64%, 64% of the time up, 68%, 60%, so on and so forth. The 6-month and the 12-month return positivity rate is higher than the 1 month, 2 months, 3 months, and 4 months, but in general, usually higher. So yes, gains beget gains. Know your studies, folks. And again, a lot more data to cover here. Downgrading, here's Wells Fargo. They have a completely different opinion. They just downgraded technology. Another potential headwind is the proposed increase in corporate tax rates, which matters to the information technology and consumer discretionary sectors. Therefore, we have downgraded the consumer discretionary and information technology sectors to neutral. Everybody's got a different opinion. That's all I'm trying to say. So again, as an investor, you got to think long term. You have to give yourself time. If you can, if you don't have that itch to scratch going after the meme stocks, and you don't have that FOMO, that's great. But if you do have that itch, go scratch it. Take a small position, get it over with. Maybe you make $1 or $2. But the best investors that I know, they stick to their game plan. They execute. They know what to do with dips. They know the buy the dip signals that we've talked about in the past. So with that, stay true to your disciplines, folks. And we'll see you next time here on the State of the Market.